Right now, while most investors are chasing yesterday's winners, a handful of companies are quietly building the infrastructure that will power the next decade of American prosperity. I'm talking about businesses that aren't just riding trends, but actually creating them. Companies where the gap between current price and future value is so wide that patient investors could see returns that completely change their financial future. The next 10 minutes could shift how you think about building lasting wealth, so stay with me. Welcome to Market Edge, where we cut through the noise and focus on what actually matters for long-term investors. If you're serious about understanding markets beyond the headlines, make sure you subscribe and turn on notifications, because we're building a community of people who think differently about money. Today, we're looking at 7 companies that represent something rare in investing, genuine structural advantages in industries that are still in the early innings of massive growth. These aren't lottery tickets. They're businesses with real cash flow, real customers, and real competitive barriers that make them hard to replace. Let's get into it. Before we jump into individual names, let me share how I approach long-term investing, because the process matters more than the picks. When you're looking out to 2030, you're not trading, you're buying ownership in businesses. That means we need to think about free cash flow, the actual money a company generates after paying all its bills and investing in growth. We need to understand the difference between price and value, because they're not the same thing, and we need a margin of safety, room for us to be wrong without getting crushed. The companies we'll discuss today all meet these criteria, but you need to do your own research and decide if they fit your personal situation and risk tolerance. Let's start with a business that literally digs value out of the ground. Think about everything happening right now. AI data centers are being built at an unprecedented pace. The Department of Defense is ramping up production of everything from artillery shells to fighter jets. Electric vehicles and renewable energy grids are expanding globally. What do all these things have in common? They all require massive amounts of copper. And here's the problem. There isn't enough copper to meet demand, and new mines take 10 to 15 years to develop. That supply-demand imbalance creates extraordinary opportunity for companies that already control large copper reserves. The company I'm talking about is Freeport-McMoRan, and they're the world's largest publicly traded copper producer. They operate massive mining facilities across Indonesia, North and South America, and Africa. What makes them interesting isn't just that they dig up copper. It's that they've developed proprietary extraction technology that lets them recover copper from waste rock that was previously considered worthless. They're literally turning old mines into new revenue streams without waiting a decade for permits. When you look at their financials, they're generating over $6 billion in annual operating cash flow. That's real money hitting the bank account every year. Their PEG ratio, which measures price relative to growth, sits below 1, suggesting the market hasn't fully priced in the coming surge in copper demand. Analysts expect military copper consumption alone to triple by 2040, growing at over 7% annually, and that spending is completely inelastic. National security doesn't pause when copper prices rise. The risk here is cyclicality. Commodity prices go up and down, and mining companies feel that volatility. But when you're looking at structural undersupply meeting exponential demand growth from AI, defense, and electrification, the long-term thesis is strong. If you believe those trends are real, and I do, then owning the company that controls the supply makes sense. Comment below if you're tracking copper demand, because this is a conversation worth having. And if you're finding value in this video, share it with someone who's serious about investing. It helps Market Edge grow. Now let's shift from what's underground to what's happening inside operating rooms across America. Healthcare is changing rapidly, and one of the most profound shifts is happening in surgery. For decades, operations required large incisions, long recovery times, and significant trauma to the patient's body. Robotic surgery changes all of that. Smaller incisions, greater precision, faster recovery, and better outcomes. This isn't a future technology. It's happening right now in thousands of hospitals, and one company dominates the space so completely that switching away from them would be like ripping out a hospital's entire nervous system. That company is Intuitive Surgical, and they make the Da Vinci surgical system. These are multi-million-dollar robotic platforms that give surgeons superhuman precision. They've installed over 10,700 systems globally, and here's where it gets interesting. Once a hospital buys a Da Vinci system, they don't just pay once. Every single procedure requires proprietary instruments that wear out and need replacing. It's the razor and blade model, but for surgery. That creates recurring revenue that's incredibly predictable and profitable. We're talking about 70% gross margins, the kind of profitability you'd expect from software, not medical devices. The FDA just cleared their newer single-port system for additional procedures, expanding the addressable market even further. When you analyze this business, think about the moat. Competitors like Medtronic and Johnson & Johnson are trying to catch up, but Intuitive has 20 years of clinical data, tens of thousands of trained surgeons, and a global service network. That's not something you replicate quickly. Their customers aren't just buying equipment, they're buying an entire ecosystem of training, support, and proven outcomes. As you look toward 2030, more surgeries will be robotic, not fewer. The trend is clear, and Intuitive is positioned at the center of it. The valuation isn't cheap, but quality rarely is. What matters is whether the growth justifies the price. And for a company expanding both its installed base and utilization rates, the math works for patient investors. Let's talk about something most people don't think about, but that's absolutely critical to the AI revolution. Everyone focuses on chips like Nvidia's GPUs, and those are important, but GPUs can't function without a specific type of memory called high bandwidth memory. This memory sits directly on the GPU and feeds it data at incredible speeds. Without it, AI training and inference simply doesn't work. And here's the kicker. Only 3 companies on Earth can manufacture this memory at scale. That's not an exaggeration. 3 companies. Samsung, SK Hynix, and the one we're discussing today. That company is Micron Technology. They're the only American player in this 3-company oligopoly. Think about what that means from a supply and demand perspective. AI demand is exploding. Every hyperscaler, every cloud provider, every enterprise building AI infrastructure needs this memory. But supply is constrained by the enormous capital requirements and technical complexity of memory manufacturing. You can't just decide to start making high bandwidth memory. It takes billions in specialized equipment, years of development, and decades of intellectual property. That creates pricing power, and we're seeing it show up in Micron's results. Their most recent quarter showed revenue up 57% year over year, and free cash flow surged by over 7,800%. Now, those aren't typos. The cash generation is accelerating dramatically. When you invest in Micron, you're betting that AI infrastructure build-out continues, and that memory demand grows faster than supply. Nvidia is their largest customer, and as long as Nvidia keeps shipping GPUs, Micron keeps shipping memory. The market sometimes treats Micron like a cyclical commodity business, which creates opportunity for investors who understand the structural shift happening in AI. Analyst estimates suggest continued strong growth, but the real insight is recognizing that this isn't a normal cycle. This is the early phase of a multi-year infrastructure build-out that requires more memory, not less. The financial strength is there, the technology is proven, and the customers are locked in. For long-term investors, Micron represents leverage to AI growth without paying Nvidia's valuation multiple. Now let's move to a company that's solving one of the biggest problems in modern commerce. E-commerce keeps growing, which means warehouses need to move more products faster than ever before. At the same time, labor is getting harder to find and more expensive. The traditional model of humans walking miles through warehouses picking items off shelves simply doesn't scale. That's where automation comes in, and not just basic conveyors. Fully autonomous robotic systems can store, retrieve, and organize inventory with machine-level efficiency that no human workforce can match. The company leading this transformation is Symbotic, and their client list tells you everything you need to know. Walmart, Target, Albertsons, and now Medline, one of the largest medical supply distributors in America. These aren't pilot programs. These are full deployments across dozens of massive distribution centers. Walmart alone is implementing Symbotic's technology across all 42 of their U.S. regional distribution hubs. When the largest retailer in the world makes that kind of commitment, they're not guessing. They've run the numbers and determined that automation delivers better results than human labor. That advantage is permanent, not temporary. What's fascinating about Symbotic is their backlog. They have $22.5 billion in contracted future revenue. Their current market cap is around $40 billion, which means over half their valuation is already backed by signed contracts. That's years of locked-in growth. They recently acquired Walmart's entire advanced systems and robotics division. This expands their capabilities into in-store micro-fulfillment for same-day e-commerce delivery. The tailwinds are obvious. Reshoring manufacturing to America means more domestic warehouse capacity is needed. Labor shortages aren't going away. E-commerce penetration keeps growing. Every one of these trends benefits Symbotic. They're capturing share in a market that's still in early innings. The risk is execution. Deploying complex robotic systems at scale is hard, and any delays or technical issues can hurt. But the validation from the world's largest retailers suggests the technology works. For investors looking at the future of logistics and supply chain, Symbotic is building the infrastructure that will move products for decades. Share your thoughts in the comments, especially if you work in logistics or warehousing. Real-world perspective always adds value. Let's talk about something that sounds like science fiction but is actually happening right now. Quantum computing. For years, people dismissed it as too far away, too speculative, too uncertain. And yes, it's still early. But the money flowing into quantum research is real. The government contracts are real. The partnerships with Amazon, Microsoft, and Google are real. The potential applications are worth hundreds of billions of dollars. Drug discovery, financial modeling, cryptography, and materials design all stand to benefit. The question isn't whether quantum computing will matter, it's who will lead the race. The company with the strongest position is IonQ, and they use something called trapped ion technology. Without getting too technical, they manipulate individual atoms with lasers to perform calculations classical computers can't solve in our lifetime. DARPA selected IonQ for their quantum benchmarking program. That's not a participation trophy, that's the Department of Defense choosing them over every competitor. They're also the only quantum company available on AWS, Azure, and Google Cloud simultaneously. That distribution advantage matters. It puts their technology in front of every enterprise and researcher already using those platforms. The financials are early stage, but the trajectory is clear. Revenue grew 222% year over year. They're sitting on $3.5 billion in cash with zero debt. That gives them years of runway without dilution risk. The total addressable market is projected to approach $200 billion by 2040. Governments worldwide are investing billions because quantum is a national security priority. For long-term investors willing to accept higher risk, IonQ offers exposure to a technology that could redefine entire industries. It's speculative, but the institutional validation is real. Now, let's discuss the infrastructure that makes AI actually work in production. Everyone talks about AI models, but models need somewhere to run. They need massive computing power, specialized networking, and GPU-optimized infrastructure. The big cloud providers are generalists. Amazon and Microsoft built platforms for everything. One company built exclusively for AI from day one. That focus is creating extraordinary results. That company is CoreWeave, and they provide pure-play AI cloud infrastructure. Their customers include Nvidia, OpenAI, Microsoft, and Meta. Nvidia itself uses CoreWeave to run workloads. That's validation at the highest level. The growth is staggering. They went from near zero revenue to $4.3 billion in trailing 12-month revenue. Projections point toward $10 billion next year. Their gross margins are almost 74%. Those are software-level margins in a capital-intensive business. That tells you they're providing value customers can't easily replicate. The most important signal came when Nvidia invested $2 billion into CoreWeave. That investment was made at essentially the current valuation. Nvidia has better visibility into AI demand than anyone. For them to invest now is ultimate smart money validation. Analysts estimate a 10 gigawatt data center capacity shortage every year through 2028. Someone has to build that infrastructure. CoreWeave is doing it faster and more efficiently than traditional providers. The risk is competition and capital intensity. But the growth trajectory and institutional backing suggest this company is winning a race that matters. And now, the company with the most compelling long-term thesis of all. This is a software business serving the most powerful institutions on Earth. Governments, defense departments, intelligence agencies, and major enterprises rely on it. Replacing it would be practically unthinkable. That company is Palantir Technologies. The stock is down over 35% from recent highs. Some see that as a red flag. I see it as an opportunity. Palantir just reported extraordinary results. Revenue up 70% with margins expanding dramatically. Operating margins jumped from 1% to 41%. Gross margins exceed 84%. Free cash flow margins reached 56%. U.S. commercial revenue grew 137%. This is not incremental progress. This is escape velocity. Palantir's core technology is ontology. It creates a digital twin of an entire organization. Every data source, workflow, and permission is unified. Their AI acts on real objects with real constraints. Once a customer builds on ontology, switching becomes nearly impossible. Net dollar retention just hit 139%. Customers are spending more every year because they're expanding use cases. That's organic expansion, not aggressive upselling. On the defense side, they secured a $10 billion Army contract. They also signed a $500 million Navy deal. NATO adopted their software. Government revenue grew 60%. On the commercial side, U.S. customer count reached 571. That's up 49% year over year. Combine that with 139% retention. The result is explosive commercial growth. They beat full-year guidance by over $1 billion. They're sitting on $7.2 billion in cash with zero debt. They don't compete with cloud providers. They sit on top of them. The moat is widening. Analysts who understand Palantir see decades of dominance. For long-term investors who can handle volatility, Palantir is one of the highest quality compounders available today. So let's recap what we've covered. 7 companies across 7 industries with one common thread. Each has structural advantages in markets with years of growth ahead. Investing isn't about perfect predictions. It's about positioning where odds favor you. Some will face challenges. But together, these are intelligent bets on early-stage trends. If this video added value, explore more content here on Market Edge. We're focused on process, not hype. Drop a comment with your thoughts. Which company interests you most? Thank you for watching. I'll see you in the next one. Quick disclaimer, nothing here is financial advice. This is educational analysis and personal perspective. Always do your own research and invest responsibly.